Hello, everybody. If you're connecting remote, it's good to see you all. Let's we'll get started in a few minutes. Okay, we'll get started here. Let me share my screen, and hopefully you're enjoying the warm weather. It's a little warmer than usual over here in New Jersey, so I will give you that. But not bad, not terrible. I think we're gonna get some rain today. So what are we doing today? We're going through chapter or module 4. So hopefully you're doing well with this. So far, I like everything I see in terms of grading. I don't see any major issues, but if you have any questions, of course, you always know where to reach me. And I'm always here for you. But let's just take a look at what we're doing this week. Continue to grade. I've graded some of module 3. I'll continue to grade the rest of it. Most important thing I could tell you is you need to complete everything. Some of you have been missing some assignments. Most of you have completed them, but make sure you get all your assignments. It's really important. Okay, very crucial that you do that. Right? You do not want to fall behind because we're already in week 4 and this is only the 6-week class. So you want to definitely take care of that. Okay. So once again, I can't stress that more. I can't be more emphatic about that. You need to get that done. Okay, so once again, get your any assignments that you are missing, get it done because we're already in week 4. I won't penalize you because I know this is an online class and we're dealing with COVID and we're dealing with online, and I'm very pro student. But at the end of the day, you got to get it done because once the class ends, I have to submit grades. So just be aware of that. Okay. Okay, so this week we're going to be looking at risk. Right. Here's the overview and activities. We're going to explore the intended measure and scenario sensitivity analysis. We're going to look at statistical instruments as a risk management tool, and we're going to look at different financial management metrics. And we're going to explore the use of options in mitigating the risk of currency fluctuations. So we have, so what I want to start with risk itself. Okay, so let's go to that. So this is module 4, the course project. Part of the course project is risk identification. And based on the information you've learned with different types of risk, scenario, and sensitivity analysis, you'll be identifying the risks that will be associated with the IPO and global expansion. Using your readings from this module, provide your recommendation in an 800-word paper, APA. You know where to find this stuff by now. It's in the course help, course materials. You can get any information you need. We went through it in last week's video on APA and how to do APA. If you have any questions, just go back and look at your resources. It's all there. It's in the library section, and the school does a great job giving you that stuff. But we want to look at currency risk, right? What's currency risk? We want to look at transaction risk, translation risk, economic risk. And how would you use sensitivity and scenario analysis to make your recommendation? Spell out the advantages and disadvantages of each method. Submit your completed assignment by following the directions below, and there you go. Same thing that we always do. So that's your course project, is risk identification. So let's take a look at what are different types of risks. So I put this up in the discussions this week because I thought it was very helpful. I liked what I saw. So transaction and translation risks are two major types of exchange rate risks. Really what we're talking about is if you're a company doing international business, well then presumably you're also using a different currency. I mean, the US dollar we know is accepted everywhere. Anybody who's ever traveled knows that the US dollar is always acceptable. But when you're actually doing business in another country, you have to transact in that current country's currency. So, for instance, if you had a subsidiary in Germany, just to pick a place, you would be doing business in the euro. If you had it in Japan, you'd be doing business in the yen. People get your employees, if you have any, would be expected, or your suppliers, to get paid in yen. You would be getting paid in yen or in the euro. So what that does is it gives you a currency risk, right? Gives you a currency risk. And the translation risk is the exchange rate risk resulting from converting financial results of one currency to another currency. So what is transaction risk? It's the exchange rate risk resulting from the time lag between entering into a contract and settling it. Exchange rates are subject to continuous changes. So we know through economics, and I'm going to go to the Wall Street Journal site for a minute. We know through economics that we have exchange rates change all the time. And when I say through economics, how does that happen? Well, think about it for a minute. You have this exposure to another country's currency. So, for instance, I sell $1 million euros worth of a product in another country. Let's assume that I've paid my employees and I paid my rent and everything else, because that's also going to give you risk. But let's just look at the contract itself to make this simple. So I sell $1 million of pick whatever you want. I'll call it you're selling I don't know, cell phones. So you sell a million cell phones. Think about it like a company like Apple. You sell a million cell phones in Germany, and you enter into a contract where you're selling these cell phones. So first of all, where would they sell these cell phones, right? So you make the contract to sell them. The suppliers buy them from you. So first, where do you find information on exchange rates? Well, you can find them just about anywhere. But as I tell you, you always want to use the Wall Street Journal website. And if you do that, go to Market Data Home. What I did was I you could find it on the internet too, but I like using the financial presses because it gives you a lot of information. So I go to markets and I go to currencies, and there it is. So I have all these different currencies. And why do currencies move against one another? Well, because of the exchange, the flow of capital. If people in the Eurozone want to invest in the United States, maybe they want to buy property here, maybe they want to buy our goods, for whatever reason, they want to buy into our stock market, they're going to be wanting to buy US dollars and giving up euros. And that's going to drive down the price of the euro and drive up the price of the US dollar. They're reciprocals of one another, right? As the euro goes down, the dollar go up. But on the other hand, if we want to go ahead and buy products in Europe, and I'll talk about that in a minute, well, then we're going to buy euros and sell US dollars, and that's going to drive down the exchange rate of the euro, of the dollar versus the euro. Now we see, looking at this chart, we'll go to year to date, that's a Swiss franc. Let's go to the euro. Using the euro has traded in the last year as high as 123 and as low as 117. And it's been hovering around the same level, about 121. So that means, what does that mean? That means I need $1.21 to equal a euro. So now I've sold $1 million, a million euros of my cell phone. So let me pull up a Excel spreadsheet, and I'm going to put $1 million in. Dollars. And I know we're going to use an exchange rate of 1.21. So I'm going to code 1.2. So I need, so in dollars, even though I sold it to them, I'm exposed to, and I'm exposed, and I'm gonna get this money in 6 months. So I gave them the stuff on consignment, and in 6 months they're gonna pay me once they sell everything. So there's my exposure. So right now, at 121, how much exposure do I have? Well, I take $1 million times 1.21, and I got $1.210 in exposure. I'll make that pretty by making it into dollars. Okay, bear with me. So now I've got $1.210 into exposure. Now 6 months later, now where does the euro trade? Well, if I do nothing and if I don't hedge the exposure, and we're talking about hedging the exposure in this list today, let's assume that the dollar strengthens against the euro, which means you need less dollars to buy euros. So let's assume it goes to $1.10, which you traded as almost as low as parity, meaning a dollar equals a euro. But let's assume now you only need $1.10 to get the money back. That's one scenario. We'll call that scenario. And in scenario 2, we're going to assume that the dollar moves against us, that the euro becomes more valuable, that people want more euros and start selling dollars. So it goes to 1.3. Well, now it's time to get paid 6 months later. We'll say a year later, make it easy. So it's a 1 year horizon. And in a year, we've done nothing, and now we get paid back. So when the payment comes in, if in the good scenario, I now have 1 million euros, right? Now have 1 million euros. And when I translate it back, okay, when I translate it back, okay, since the dollar strengthened, okay, and my contract was for 1 million euros, they're going to give it back to me at $1.1, right? They're going to give me back these euros. And when I get the €1 million, all right, I've entered $1.2 million in exposure. I now hold $1 million worth of exposure to the euro. And when they pay me back and I translate it back into dollars, I take a hit. Take the million, right? $1 million, €1 million times $1.1. And notice what happens. I'm only getting back $1 million more. So I've actually taken a $110,000 hit by not hedging my currency. Right? And why did that happen? Because I effectively, once I gave those cell phones and entered into a contract, I'm now waiting for the euro, and I'm effectively long the euro. I'm exposed to the euro. So that should hopefully make sense to you. I'm now exposed to the euro because my product is out there, and effectively, until I get back the euro, I have to translate it back to dollars. And if the dollar strengthens, this works against me because now I'm a holder of euros, even though I'm a US company. What happens in the other scenario? Well, in the other scenario, the dollar has now weakened and the euros became more valuable. I needed $1.3 to buy the euros. So when I multiply that, what's happening? So when I multiply that, I get $1.3 million. But actually, I get a profit, which is happy news for me. So I took the exposure on the euro and I made money because effectively I held euros when I came back into dollars. Since the euro was now had now strengthened against the dollar, I got more dollars back and I actually profited. So even if I assumed I was making a 20% profit on this deal, now I could add another 90,000. But keep this in mind when we talk about, so these are different scenario analyses. But keep this in mind when I'm using currency exposure. My shareholders, generally speaking, did not bargain on the fact that I was going to take currency risk, right? They didn't invest in my company. They invested in my company because I sell cell phones. They didn't invest in my company because I take currency exposure. So in this case, they're going to be a little annoyed with me because they're going to say, "Well, we like the idea that you can make 20% on your cell phones. Why did you take currency exposure? Now we wound up losing money, right? We could take our own currency. Remember, your investors could hedge their own currencies. They can go out and then if they know your company is exposed to different currencies, an investor can essentially hedge it off if they wanted to by entering the markets themselves. Theoretically, that could happen. And even if you make a profit, I know most people are never annoyed when they make a profit, but you've made a profit on a risk that I didn't bank on. And that's the idea behind translation risk. Now, they talk about options. So options allow us, or forward contracts also allow us, futures, forwards, options, they all allow us to mitigate our risk. So we can go into the markets a year from now and actually lock in. So let's assume that in this transaction, I sold $1 million, and these are euros actually. That dollar sign is wrong. That dollar sign should actually be a euro. Let me see if I can get that in. Try that. Yeah, no, it is euro. There you go. There you go. There's the euro sign. So I entered into €1 million contract, right? Let's assume that I had a 20% profit, which means I'm expecting to make back 200,000 euros. But I have this risk, right, in a year. Now let's assume I look at the forward contract, and the forward contract a year from now allows me to translate into 1.17. And I'm not going to get too deep into it, but a lot of these, the relationship between the forward contract and this and today's currency risk is a function of the time value of money. Because effectively, I could take money in one country, translate it into another country, put it in a risk-free bank account, and they should equal one another. Because if I could make more risk-free, I would do the arbitrage. There would be an arbitrage. In other words, I could buy a euro, right? Put it in a bank account. And if I could lock in a better price than what I'm going to earn in a risk-free bank account, I'd have a riskless transaction. Think about it. I go ahead, I take my dollars, I buy euros. I put the euros in a bank that pays me, say, 5%. And if I'm able to lock in a higher than 5% profit, I'd have a riskless arbitrage, and funds would go in there and they would go crazy doing this thing. They would leverage their money, they would make a fortune. But that doesn't exist in the real markets. Currencies have to equal out. There has to be an equilibrium because of the time value of money, because of the riskless rate of exchange. That's a little deeper than we normally get into, but you want to be aware of that. That whatever the differential is, there's not going to be free money. Free money doesn't exist. The markets are efficient, and the markets will go in and correct for that. They will go in and say, well, it shouldn't exist. You shouldn't be able to go out and buy a currency in one market, invest in that market in a risk-free rate. I say risk-free because if you take a risk, then you got a risk problem. That's a whole different kettle of fish. But here I got the risk-free return, and then I can enter with a contract to come back at a price that allows me to keep the profit. Well, I can leverage my money and make a fortune. So that's not going to happen. So this $1.17 is going to be a function of the interest rates of the two countries. So if I enter into this contract, what happens? I can come back into dollars. I'll take that times 1.17. Just type it in this. And I've locked in 1,170,000. Now it's not as much as the profit I thought I was going to get, but it's enough of a profit to make my shareholders happy. And that will enter into that contract. And I would do all of this work before I even begin the contract. I know what the forward contract or the future contract is going to be in a year. I would factor all those things in, and that would allow me to profit from this. So hopefully this makes sense to you. So this is your exposure. Now, don't forget, as a multinational, you're going to have to pay employees, so that's going to mitigate some of your risk because some of the money that comes in is going to go out to pay your expenses in the real world. You have to pay rent, you have to pay insurance, you might have to pay lawyers. So all the profit you make doesn't necessarily have to come back to the United States. It's only going to have to be the net profit. But that's what a CFO does. They figure out what the net exposure is, and then they enter into a contract. Or if it's a private company or a company that expects to take risk, like a gold mining company or an oil company, they may just decide to take the risk. As long as it's disclosed to their investors and their bankers, or if it's a private company, they don't have to disclose it to anybody. And think about it when you go traveling. If the dollar is at $1.10, okay, let's look at it for a minute now. Today the dollar is at we'll call it 1.2. And we'll look at two scenarios: the dollar going to 1 or the dollar going to 1.5 and 1 point. Let's say the dollar going to 1 or the dollar going to 1.4. So it makes 20 cents. It's not the same, but makes around the same movement. And I want to go and take a trip to Europe. And I find out that when I look at the prices, I'm going to have to pay $2,000 for a week's hotel, whatever that is, $300 a night. So it's going to cost me $2,000 US to buy a hotel for a week. Well, if the dollar is at 1, if the dollar translates 1 to 1, well, this is simple. This is stuff you deal with every day. And I'm going to need $2,000 to buy the hotel. Right? But if the dollar equals 1.4 euro, look what happens. I'm going to need 2,800. So when the dollar gets strong against the euro, or you need less dollars to buy euros, it's a lot cheaper to go to places like Europe or buy European cars or buy European handbags because your dollar now buys more goods. And if it weakens, then I need more money. And that's the whole thing with trade. When you look at countries' trade, the argument has always been that the Chinese have kept their currency artificially low. And you hear that over and over again when you read trade articles, because they export a lot of stuff to us. And if we can buy more with our dollar, we're going to buy more goods, and they're an export economy. And the same as could be said about other economies like Japan any country does a lot of exporting. We happen to have the reserve currency, which is the dollar. So we try to keep the dollar strong. So we denominate oil and gold to the dollars, and that gives our currency real value on top of everything else. This is deeper and this is more economics, but you want to definitely understand that there's a relationship between the euro and the currency exchange rates and trade. You know, the weaker your currency to another country, the more goods you can sell in that country. Okay. And obviously, when your dollar gets stronger in another country like euro, people are going to want to take trips there. I mean, we got COVID now, but it becomes more palatable to take trips because now people say, you know what, I can get a hotel room for $2,000 as opposed to 2,800 when when the dollar is weak. So hopefully this makes sense to you. This week's code word or your word you have to give me in the live thing is going to be hedge. The word is hedge. Okay. These are just different scenarios. And that's scenario analysis, basically, in a nutshell. And they give you an example here. The beverage company ABF is a commercial organization, and they got 600 barrels of oil. Who is an oil exporter? Since the oil prices are continuously fluctuating, they enter a contract. So effectively, what this thing is telling you, and you should go over this yourself, is that by using options, swaps, or futures, just like I showed you, you could mitigate your risk. So go over this, and you'll see the same thing I showed you. And transaction risk is the exchange risk resulting from the time lag between entering into a contract and settling it. There is an actual change in the future outcome and the actual change. And transaction risk can be mitigated by entering into a hedging agreement. A couple of things you want to know from more um, deeper financial and economic theory. One is when you enter into a hedge, let's say you're an airline and you know you have energy exposure. You go out and maybe hedge off and buy your oil ahead of time. We see that sometimes when people have heating oil. I don't know if any of you out there have heating oil, but some of these companies allow you to lock in your heating oil cost in like June. So you know what you're going to be paying in December. They're just effectively going out and hedging for you. And they're allowing you to benefit from that. As long as who would be on the other side of the hedge? If I'm an airline or I'm a I'm a homeowner who wants to hedge off my heating oil exposure, I'm effectively locking in the price of oil. Who would want to lock in the price? Who would want to sell me oil? Think about it. The other side would be locking into the contract that would lock in their sale of oil, right? You're buying oil. The hedge, the natural hedge would be the counterparty who wants to sell oil. So you're buying oil, let's say right now, we'll use the price of gasoline. Gasoline is trading in my local area for around $3 a gallon. Let's say, we got a fleet of trucks and you're going to be using 10,000 gallons of gasoline in the end of the year, and you want to lock in your cost at $3 because at $3, and with the contracts you have for deliveries for your trucking company, maybe you work for Amazon, you can have a fair profit for your investors and for yourself at $3. So you're going to be buying oil effectively, right, at $3 today. Now, what happens if oil goes to $2? Well, you're going to wish you waited. But if oil goes to $4, you can be happy you locked in your profit because it would have wiped out all of your profits. So you lock it in at 3. But who's actually going to be on the other side of that counterparty? Who's going to be the counterparty there? Who's going to be selling you the gasoline at $3? Well, obviously, you think about it. I'll give you a minute to think about that question. Who would be selling you the gas? Why would it benefit someone to sell you the gas? What kind of what would be the opposite party to that transaction? Because effectively, well, the water went down the wrong pipe. I wonder if there is a pipe. I don't think it's a pipe. Who knows? But someone's effectively selling oil at $3. And if the oil price of oil went down, that would be good for them. And if the price of oil went up, that's bad for them. And it's the opposite of what you're trying to do. We'll give you a minute to think about that. Take a minute, write it down, think about it. Okay, I'll give you the answer. The other side would probably be either one or two parties. We call them natural hedges. The natural hedge, that's the word we use. It's the word I use in the industry. The natural hedge would be a producer of oil. They have oil to sell. They've taken it out of the ground. They refined it. Now they want to lock in a price that gives them a profit. They took the oil out already, so they want to lock in their gasoline profit. That would be a natural hedge. The other hedge would be a speculator, just like, would be speculators also into the market. A trader who thinks, or a company or a fund that thinks oil is going down because of inflation, GDP, or a recession, and they would sell. Now, um, a financial theory tells us that when you use net, when you're trading with a natural party, a party that naturally wants to hedge, the price of the hedge becomes more efficient for both sides. So you want to know that, if you're in business. So when you're in a business like oil or gas or gold or any commodity where there's an active other side who is in the industry, right, that actually needs to sell the product because they want to lock in profits and enter the product. A cocoa company, a chocolate company like Hershey that needs to buy sugar, because all these commodities trade, those prices generally should be more efficient. So be aware of that. That's just something I'm going to throw in so you're aware of it. And if I look at the commodities, all the commodities have hedges. So you have like crude oil, you have different kinds of oil, you have gold, which trades at 1892 now. You have silver. Gold has gone up because of inflation. So I really want you to spend time with, I really hope you spend time and frankly, for $50 every 6 months as a student, you can get a subscription to the Wall Street Journal. And then you could do energy. We just talked about that. And then you got agriculture, cocoa, right? Hershey would go in and want to buy cocoa because they have cocoa needs, right? Going into the holidays or going into Valentine's Day or all different reasons. So why people love cocoa. I mean, I love Hershey. Coffee, corn, cotton. There's tons of them. Sugar. Think about a company like Nabisco that makes sugar. That makes sugar. That makes They do make sugar, but that makes us cookies like the Oreos. I love Oreos. Uh, there you go. And they may want to hedge off their risk because they know that if the price of sugar goes up, they can obviously lose money. They need sugar. So anytime you have the natural of the party, it should be more efficient. So hopefully, and here's a nice article that you should take a look at. Option traders bet on the return of $100 oil. Traders have alighted on what some believe to be a one-way bet in the world's most important commodity, oil going to $100 a barrel. They have scooped up call options. Now, these are speculators reaching $100 by year. Oil prices haven't topped that milestone since 2014. Okay, when a gush of U.S. crude depressed energy markets. So owners of $100 options, most widely used call contracts, are making a leverage bet that oil prices will hurdle higher after already surging more than 40%. So they think it's going higher. Now, from a lifetime trading in the markets, this is tricky, right? This is very tricky because we know just by what happened with COVID how fast you can get, lose a lot of money by speculating because anything can happen, right? We have two kinds of risk. We have systematic risk and unsystematic risk, right? We talked about that. Unsystematic risk are risks that are indigenous to each company, right? So we can kind of hedge that out. But there's always the systematic risk. The idea of a COVID. Let's hope this is over now. The idea of a just something that you can't predict, and that could drive down the price of oil. So you got a lot of stuff going on. But this at least tells you that there is definitely speculators in the market that are not natural hedges. And then they talk more about the supply demand equation with oil. So hopefully that makes sense to you. Very careful. So, any questions on this? Well, we're doing this remote today, so there's not going to be any questions. But I just wanted you to be aware of that. Once again, the keyword is hedge. Keyword is hedge. All right. So that really gives you a lot. That gives you a lot. Let's go back to this week's work. So we talked about this kind of risk. And actually, we also gave you a little view of how it works. This article here. And if you go into our week's work, you're also going to see that they give you a bunch of stuff. Scenario and sensitivity analysis. So they do the same thing. And they actually tell you all the different costs you want to look at when you do this scenario analysis. You want to look at your projected revenues, your fixed costs, which are costs that you have to pay, and your variable costs, which are costs that fluctuate with sales. So when you do cost accounting, and I hope some of you have done accounting, you would look at two types of costs. The ones that you have to pay, like rent and insurance, things that you're locked into, and then your variable costs. So let's say, what are variable costs? Well, if I'm selling, say, pizza, I own a pizzeria. Well, what are my fixed costs? And what are my variable costs? I'm going to give you a few minutes to think about that. I own a pizzeria, right? And I'm trying to project my revenues, and I'm doing business overseas, so I have risk. Wherever I have it, I always have risk, right? Even in the US, I have risks because inflation can hurt me, right? I might be paying for things, and then all of a sudden, like I even go to the store now and I see in the last month or two the price of food has gone up. Things are gone up. Well, that's risk, right? I can't. I don't know how I would hedge that. Maybe just by how you hedge these things is it's good to own a home because the home value will go up with inflation, so that's a good thing, right? It's good to own certain stocks, maybe gold. There are different ways you can hedge inflation indigenously. Home buying has always been a big help. The price of your home goes up with inflation, so that kind of mitigates your inflationary costs. But we have revenue costs, fixed costs, variable costs. I'm going to give you a minute. And I want you to think about that, and I want you to tell me if you own a pizzeria, where's your fixed cost, where's your variable cost? Okay, I'm back. And the fixed cost would be for a pizzeria would be your rent, would be any leases you have, maybe you're leasing your equipment, would be insurance, maybe even some employees that are full-time. Anytime you have an expense, theoretically, the definition we use in economics is anytime I have an expense that that it's going to extend for 1 year or in the foreseeable future, it's a fixed cost. Now, what are your variable costs? The boxes, the sauce, the cheese. As I sell more pizza, those costs go up. So part of my cost of my pizza is the fixed and part of variable. Okay. And so when I figure out my profits, I'm going to say, well, maybe I sell a pizza at $10. The fixed cost of that pizza is $3. The variable cost of $2, I make a profit of $5. And that's how I do it. So I know which part of my cost structure is fixed and I have to pay it, and which part of my cost structure is variable, and that goes with every sale I make. And by the way, if you go to my Economics Academy and you look up cost structures, it's a view of tabular cost structures, you would get an economic look at this. Matter of fact, I'm going to share it with you guys. So if I edit this, see if I can edit this. Yeah, I'm going to edit this video on course. If you want to get a little more work on that, there it is. I'm going to put it in my video on course structures. I'll put it there. And go to discussions. So we have this week's discussion. You guys do great on the discussions, by the way. And I'm going to add that. My video explaining fixed and variable cost. So it's actually pretty neat if you want to watch it. It'll explain this even further. And I can get something called operating leverage. So what's operating leverage? Well, let's talk about that for a minute. So what's operating leverage? So let's say I sell 100,000 pizzas in a year. And my fixed cost is $3. So I have a cost of $300,000. And my variable cost, my boxes, let's say my boxes, my sauce, and everything else is $2. So that cost is going to be $100,000. Well, let's say I could, I'm going to make a decision. My company is growing. I'm selling 100,000 pizzas a month. I have a bunch of pizzerias, and I get these fixed and variable costs. But now I get a proposition. I can invest in a company that sells all the boxes, the sauce, and the cheese, and I can make an investment in that company. And when I make the investment, forget the profits. I can get a profit, but by making the investment with the company, I can effectively hedge my risk, and they will deliver all that product to me every year, guaranteed, for $500,000. So that's my contract. Give us $500,000. You're an investor. We'll make sure you get everything, and you'll be locked in. You should become a part owner. Okay. So now I have to look at the proposition. Well, you want me to pay $500,000, right? And my company is growing. So where does it make sense for me? Put the $500,000 here. And we're going to take, so at one point, really what we want to know is, when does my cost go above $500,000? So if I'm selling 200,000 pizzas, it's going to cost me 200,000 times 2 is 400,000, right? Where does $500,000, say, equal to $500,000, divided by 250,000 pizzas? Because think about it. Once I get to 250,000 pizzas at the variable cost of 2, for some reason it does that. Okay, so let's put it here. Once I get to 500,000 pizzas at a variable cost of 2, bear with me for a minute. So once I get to variable pizza, once I get to 250,000 pizzas at a variable cost of 2, I have $500,000 in cost. So every pizza I sell above 250, I've locked in at 500 and I make an additional profit. So maybe I want to enter it if I project that I'm going to be growing my business. And that's the beauty behind McDonald's, Starbucks. It's called economies of scale. Home Depot. They could spread their costs over more and more variable. They can spread, and so effectively, maybe they cut a better deal on the cups. Maybe they cut a better deal on the coffees in case of Starbucks. Maybe McDonald's cuts a better deal on the French fries. And they've effectively hedged off their risk or created operating leverage. So there you go. So that's another way I can hedge my risk. Okay. So I want you to focus on that. So you learn more about exposure. Okay, so finally, we're going to come to almost come to the end of our session together. I'm going to make sure I have enough time. And by the way, I expect you to go over this on currency fluctuations, which we already did. Let's talk about the second project, which is we want you to go in and go into Mergent Online and okay, we got risk management techniques, risk management analysis. Let's see what this is. So we want you to go into Mergent, like you did last week, and pick one of these companies and look at how they analyze risk and put a 500-word document together. Well, you could do this a number of ways. You can go into Mergent, which I suggest, so at least you'll learn how to use Mergent. Of course, all that stuff is on tools, institutional tools. Or you could just call it up. So how do I do it? You could just call up Apple. And any company you can do this with. Investor relations. I want you to learn how to do this too. There's also the SEC has a website called EDGAR. But in Apple Investor Relations, and I'm already in. And now I want the annual report. And I just have to search for it. And every company has these. So I'm just going to click on the annual. And this is they would send it to me. If I click on this, they actually put my email in and I'll get the annual reports. But I'm not going to do that. I just want to get the annual. So for 2021, I want the annual filing. We don't have it. How about 2020? There it is. So I'll call it up in a PDF. You can pull it up in any number of these formats. Obviously, it's Apple, so they know tech, right? And when you go into it, you're going to read through this annual report. And it's really helpful for you to do that. So we're going to go right to risk factors. But if you notice in the table of contents, you're going to get everything here. Well, let's go to risk factors. Just take a look at that for a moment. Keyword being hedge. So we're going to click on risk factors. And you can go through these, and these are all itemized in order of importance. And by the way, when you put in, anytime you look at an annual report of a serious company that has really good lawyers, and no companies better have good lawyers, they're going to itemize every risk that they have. Because they're not going to want an investor to come back and say, well, you took a risk that we didn't bargain on. Because you can get sued for that. You can get in trouble for that. But we talked about it before. If you're going to hedge off any of your risk, or you have any risks that are identifiable, obviously it's a reasonable, I'm not a lawyer, but my son is, and I know a lot of lawyers. A reasonable man assumption is that it's got to be a risk that you can reasonably foresee. And COVID would not, you wouldn't be held to COVID because that was an act of, nature or God or whatever you want to say, but not God, great old COVID. You know what I mean? It was an act of nature. So it's something you couldn't predict. So if it's something you can't predict, no one's going to hold you to that. But if it's something like Hurricane Sandy on the Jersey Shore or Katrina, but if it's something that was predictable, well, you might want to talk about it. And actually, if you live in a flood zone, maybe you do have to be aware. So these are all lawyer questions. But the company's business results of operation, financial conditions, stock price have been adversely affected and could be in the future. Global and regional economic conditions could materially adversely affect the company's business. So this is all economic issues that they tell you about. Global markets of the company's products are highly competitive and subject to rapid technological change. And as you read through these, you'll see that this is all Apple. To remain competitive and stimulate customer demand, the company must successfully manage frequent introductions and transitions of products. The company depends on the performance of carriers, wholesalers, retailers, and other resellers. So that's another risk they have. We just talked about that in a fictional scenario about you selling cellular phones in another country. Company is exposed to the risk of write-downs on the value of its inventory. Maybe the stuff doesn't sell, and it is stuck with it. That's what they're telling you, basically. Future operating results depend on the company's ability to obtain components, supply side, supply chain. We saw that problem during COVID. Supply chain issues. Maybe stuff gets more expensive. The source. Company depends on component and product manufacturing and logistical services. Company's products and services may be affected from time to time by design and manufacturing defects that could materially adversely affect the company's business. The company relies on access to third-party digital content, all the apps. What happens if the apps don't work or the apps aren't available? It could be a problem for them. They're relying on third parties here, and they tell you that. Company's future performance depends in part on support from third-party software developers. There you go. So you're really understanding the risks to an Apple by reading their annual. That's why I urge you to always read different annual reports. The company relies on access to third-party intellectual property. Again, more intellectual property problems. Legal proceedings, that's always one for everybody. Company is subject to changing laws and regulations, which there's another liability. You could be working in a country and they change the laws. That's always a risk. So you start to, now, keep this in mind. I've been doing this for a long time. After a while, you start to see these things over and over again. So keep that in mind. After a while, you start to see these things over and over again. So you read the boilerplate. A lot of companies have, the same risks, obviously. Now, Apple has technological risks, but things like liability and legal liability, that's going to be in any company. Retail stores have required and will continue to require substantial investments. Investments in new strategies and acquisition could disrupt the company's ongoing business. And we know if history has taught us anything, that even the best companies can go out of business. It's just business. Companies' business and reputation might be impacted by information, technology system failures, and network disruptions. There may be losses or unauthorized access to release of confidential information. That could be one that could affect a lot of companies. More about laws, more about key personnel. That affects a lot. You start to, as you go through these, now you start to see the ones that are indigenous to every company. Political events can affect any company that works overseas. Operating results obviously can fluctuate. That's a boilerplate. Stock price is volatile. Boilerplate. And when I say boilerplate, it means it can apply to just about any country. And here we go. Here's one that we're talking about today. Country's financial performance is subject to risk associated with the value of the U.S. dollar related to local currencies. And that's just what we were talking about. U.S. dollar strengthening would adversely affect the U.S. dollar's value. That's exactly what we talked about today. We did that cellular phone scenario, and we saw that the strength of the dollar hurt us because we were in another currency. And that's what Apple's telling. And that strengthening of foreign currency would benefit the dollar. So whenever you're exporting things, you want your currency to be less valuable. Credit risks, and there you go. And then they give you unresolved staff comments, which is so good stuff. So spend some time with this video. You'll find it very useful. And that about wraps it up. Hedge is the key word. Contact me with anything. Make sure you finish any unfinished assignments. And of course, as always, great working with you guys. You guys are terrific.